Welcome to the Allan Small Financial Show. As always, I'd like to thank all of you for taking some time out of your busy day to spend it with us. As I mentioned on the last show, anytime we have a show on the same day that a central bank is announcing their interest rate policy, it's always exciting. On our last show, the Bank of Canada had an announcement regarding interest rates. And this show, the Federal Reserve, central bank in the US, at 2 p.m. today, will announce what they're going to do with interest rates in the US. So quite an exciting day. And we'll talk a lot about what the Federal Reserve is planning on doing, or what we think they're planning on doing. We also have a great guest today, Pattie Lovett-Reid. Some of you may recognize the name. She was with CTV as a chief financial commentator for quite a while. Prior to that, with TD Waterhouse. And she's had her finger on the pulse of the markets for many years now. And we're going to get her thoughts and ideas as to what's happening with the markets, Bank of Canada, inflation, and all of that. But we also have a number of other topics that I think that all of you will benefit from discussing. And here they are in front of us now. So again, we're going to talk about investing, inflation, in the economy with Pattie Lovett-Reid. We have our usual This Week segment where I talk about what I believe 3 points that individual investors need to consider before they make their investment decisions. Economic pressures felt by Canadians. They may not be reflective in the data as yet. We're seeing still relatively strong data out of Canada and the US, yet talking to a lot of people on the ground, the average person walking the streets of Toronto or wherever they may be, they're finding it difficult, yet not being reflected in the data as yet. Top 3 things that brought down inflation, kind of a top 3 list of mine, 3 things that I think have really helped bring down the inflation rate. And you'll notice when we get there, interest rates rising is not one of them. Money management. What is important for individual investors to consider when they're interviewing for an investment advisor? What should investment advisors be asked when you're looking to see whether you should hire them to watch your money in your portfolio? Fourth quarter is likely to be positive for investors. I really believe this fourth quarter we'll see the markets move higher. Why? Is it just seasonal? We'll talk about that as well. And lastly, your questions. I believe we had a question that came to me during the week that I saved for the show, and hopefully we can get to a few others. If you have any questions during the show for Pattie, for myself, please enter it into the comment boxes. Love to get to those questions at the end of the show. Or if not, if we run out of time, answer those questions on our next show, or perhaps I'll even get to them during the 2 weeks prior to the next show. So without further ado, let's get on with the show. So I'd like to welcome personal finance expert and financial commentator Pattie Lovett-Reid to our show. Pattie is known for giving tips on how people can save money, stretch their incomes. Many of you will recognize Pattie from her days as a former senior financial commentator for CTV News, and she also served as a senior vice president at TD Waterhouse Canada. She's returning to our show after appearing last September. I can't believe it's already been a full year since you were on the show. Welcome to the show, Pattie Lovett-Reid.
Hi there. Thank you for having me. Yeah, you know what? That's a really long time.
Yeah,
wow. A lot's happened.
I can't believe it's been a year already. What time flies and interesting, different times, I guess, since last time you were on the show. But I'd like to, I guess, start, just have a very casual conversation about the markets in general. And I guess my first question to you, and a question I get a lot from individual investors, no matter where I go. I was actually down at CP24 the other day, and behind the cameras, producers were coming up to me and asking me this question. And they were basically asking, based on the inflation rate that we just received yesterday, do you think the Bank of Canada has another interest rate increase up their sleeve before the end of the year? And if you were the Bank of Canada, or the Federal Reserve for that matter, would you raise rates again before the end of the year?
Yes, I would. You know, different central banks. I think the U.S. Federal Reserve has done a really good job. They telegraph. They pretty much always follow suit. Not a lot of surprises, unlike the Bank of Canada, who have been known in the past to surprise us. But when you see an inflation rate of 4%, when you look at mortgage servicing costs up 30%, rent 6%, goods as well as services higher, even if you strip out the volatile components, which would be, of course, energy and food, we're still in August, it's 4.6%. And so if you believe in that 2% target, and if you want the Bank of Canada to have the credibility that it is striving for, the odds went higher on October 25th on the next rate announcement. We could see another 25 basis points. Now, I'm going to put you on the spot. What are your thoughts?
I'm actually of a bit of the opposite mindset. I think that I'd probably pause for a little while just to see how things settle out. To me, I think the recent gains in inflation have a lot to do with rising oil prices.
Yes.
Obviously, when you look at core, that's probably more important than the headline number. But I guess, which leads me to my next question. I know you speak to a lot of people and investors, small business owners. Are you starting to hear that these higher interest rates are starting to bite them? And I guess in answering my question that you asked me, I think the answer is yes. And so I think we're really starting to see things slow, which is why I would say to possibly pause. But do you think these higher rates are starting to bite?
Yeah, there's no question about it. Allan, I can't remember, at least in my period of time, and I've been around a long time, 90-year amortization rates, where you've got the trigger rate on people with variable rate mortgages exceeding their payments exceeding the interest charge. And the response is, well, make a lump sum payment, increase your monthly payments, or stretch out your amortization for a period of time, but it can't go on forever. People don't have the financial wiggle room. When I look at some of the odds and you think about this, we've been through a pandemic, higher interest rates, higher inflation, a potential recession, a war going on with geopolitical risk between Russia and Ukraine. There is a 0.25% chance that this happens all at the same time. And so if people are feeling stressed out, there's good reason for them to feel stressed out. You add to it that, yes, we've got oil above $90 US a barrel, 91. And so I kind of think about where we're at. I don't know if a 2% inflation target is realistic anymore. Are we hitting a peak rate right around the globe? I think we're getting close. I do agree with you. We got to pause. We got to pause and allow for that rapid, I think, what was it, 10 interest rate hikes since March of 2022. They do need time to catch up. And so, well, I hope I'm wrong. I hope you're right, because of people who really need that pause to happen. I do see a need to slow down certain areas in this economy to right the ship, so to speak.
And I agree with that for sure. And I think we have a chart. I think we can show that with the Bank of Canada rate as compared to the inflation rate. And obviously now the Bank of Canada rate much higher than the inflation rate. One is 5%, 4% inflation rate. So you can see that things definitely, there's some wiggle room there, right? I guess at some point, if the economy were to go into some sort of mild recession, and we did see negative GDP for the second quarter. If we do see another quarter of negative GDP, I think some red bells or some bells would go off, and I think the Bank of Canada would be, a lot of pressure would be on them to do something about that.
Right.
Want to kind of change a little bit over to the stock market.
Sure.
And you've helped a lot of investors manage money when you were at TD. I'm curious, what did you tell investors when the end of August and September rolled around? Obviously, September being the weakest month of the year for investments. Did you tell them, hold tight, let's hold tight, step back for a little bit, see where things go before we add more money? Or were you in there buying on the dip? What do you tell? Because I get, again, another question I get a lot of this time of year.
Yeah, sure. September is notoriously known for being the worst trading month of the year when you look at statistics, followed by October, even though the crash, of course, was in October. But I believe in sticking to a plan. I believe if you believe in dollar cost averaging, and I do, that when the markets are volatile, if you're buying good quality investments and your asset allocation is aligned to who you are as an investor, then you stick with the plan and you continue to see things move forward. So I would argue that yes, a mild recession, it's not like we've never been here before. And it doesn't mean it's going to last forever. And when it does correct itself, things will move forward. And what I've also seen in the past, Alan, is that the market doesn't wave a white flag and say, hey, by the way, now is the time to get back into the market. Things start to move in a preemptive way. It's very forward thinking. It thinks, okay, we are going to see some light at the end of the tunnel, and I want to be there to participate in that. And so that means sticking to my plan. So it can be hard to do. And the same with, I think, sitting in cash and letting your money be idle after what we've seen with taxes and especially inflation. That can be a dangerous place to be as well. You might not think you're taking risk, but there is risk there, of course. So I'm the kind that sticks to the plan.
Great, and obviously great plan. Yeah, I think, and you never know, right? Sometimes I know a few years ago, August and September actually outperformed, and
Yeah.
November, December were disappointing. As we know,
Yeah.
November, December tend to be the better months. I guess my last question, I'm going to ask you to put on your fortune telling or telling the
Great.
future hat, or take out your crystal ball, if you will, because I want to ask you, how do you think the markets are going to fare in the fourth quarter of this year and into 2024? Obviously, with a slowing economy weighing on the markets, and bringing, will that bring down the stock market, or do you think the stock market can power through a slowing economy? Obviously, we look at the S&P 500 this year up in around 16%.
Yeah.
What do you think is in the cards for the remainder of the year and into next year with regards to the stock market?
I think there was a period of time when there was so much talk of the economy slowing down that things got baked into the market. And I'm not suggesting we're going to see broad advancement beyond. I think there's going to be a cautious tone to the market, but that doesn't mean that you shouldn't be in the market. I'm still going to stick to my guns and say it's time in the market, not timing the market. There's no guarantee that we actually will slow down, or if it is, it could be mild and it could be an extended period of time. But the reality is that doesn't mean that there isn't money to be made. If you look at the TSX, I mean, think about the energy component with oil trading at the price that it is. Um, the reality is there is still money to be made. It just depends on where you're invested, where you're allocated. And I will also argue, Alan, that it can be about your time horizon. I've gone through a period in my life where it was very much about wealth accumulation. And now we're at a period in our life where we go, okay, we still need to accumulate, but we're into wealth preservation now. So set yourself up for success for the investor that you are, as opposed to saying, I'm not going to be there, because after taxes and inflation, you're not going to keep up your purchasing power if you don't have exposure to the market, at least in my opinion.
Yeah, no, 100%. And investment objectives, time horizon, two of the
All of
most
it.
important things, risk tolerance, all of
Sleep
that.
at night.
The know your client application form, as we call it in the industry. That's always very important. Pattie, thank you so much for being on our show. It's
Are you
always
going to wait another year?
no, definitely not. We will call you sooner than 1 year from now. It's always a pleasure having you on. It's always great to see you
Thank you.
and to talk to you. And I hope you enjoy the rest of the summer, because it looks like the weather's still pretty good out there.
We'll take it. Thanks a lot, Alan. All the
right.
best.
Have a great day. Take care.
Thanks.
Now's the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. As you can see here, 3 topics. And the first one, I'm going to say, yes, we always seem to have this topic, Federal Reserve or Fed speak. A little different today as we have a bank rate or an interest rate decision coming up at 2 p.m. today. So that's going to be important. Paying a premium for growth or paying them a premium on growth. What do I mean by that? I'll get into that as well. And circle back to chip makers. I think a lot of chip makers right now have been sold off for whatever reason. I'm not exactly sure. Perhaps it's exposure to China and all of the geopolitical things that are going on between the US and China. Maybe that is weighing on some of these chip makers. But overall, we've seen the chip makers pull back a little bit. So these are the three topics that I think you should consider before making your decision. So let's move to the first topic here, Fed speak and the US interest rate or bank rate decision for this afternoon. And today, central bank in the US, the Federal Reserve, will announce interest rates or their interest rate decision, whether it's a hike, whether to pause. I don't think they're going to cut. Most of us believe that they will be on pause, just like the Bank of Canada was on pause at their most rate decision meeting. However, I think, like always, everybody's going to parse through their, I guess, press conference afterward when they take questions, when Jerome Powell takes questions from reporters about where things stand on inflation, where things stand on interest rates, and whether or not an interest rate hike is in the cards before the end of the year. The next interest rate meeting will be, I think, at the beginning of November, end of October, and many believe that the Fed could go another 25 basis points. I think there's about a 40% chance of that right now. So we'll see what happens. And have a couple of charts here that we've seen before in the past. The U.S. Consumer Price Index, you can see here that it's changed, obviously, since the last time or last show, last time we had this chart up. All items or the headline number, 3.7%. And more importantly, what the Fed looks at is the core rate, which is less food and energy, now ticking down to about 4.3%, even though, as you can see here, the headline inflation rate has moved higher, and it's moved higher on the back of higher oil prices. The Federal Reserve actually looks at what they call super core rate, and that actually takes out shelter as well. So I'm not so sure that, as I've said many times, that you could remove shelter and food and oil and get a rate, and that's the rate the Fed should focus on. I think they should focus on the headline number. There's no doubt. To strip out volatile food and energy is very difficult because I think energy especially seeps into every part of our economy. Second chart I have here, Fed hikes key interest rates. We've seen it before. I actually love this chart. Shows you when the recessions came. Obviously, recessions came when interest rates were higher. Now, you'll notice here that the recession that hit in 2008, obviously we had a financial crisis, banking crisis in the US, so not necessarily because of higher interest rates, but you could see when a recession hit, interest rates dropped, and they stayed at that level for quite some time in the middle of that little graph there. And then started to rise again. Coronavirus, the pandemic hit, brought it back down. And now we've seen interest rates surge to about 5.5% in the US once again. So once again, many people believe that a recession could be in the cards. So it's going to be very important to listen to what not only Jerome Powell says today, the head of the Federal Reserve, but what the Fed governors say over the coming weeks, right? You're going to have many press conferences, many meetings. They're going to be interviewed by a number of reporters. What are they saying? Are they saying they're done for the time being? Are they saying one more interest rate increase? I think it's almost, as I said, a 60-40 or almost a flip of a coin, whether they raise rates again before the end of the year. The second topic that I had on that list that individual investors should consider before making your investment decisions was consider paying a premium for growth. And for me, what does that mean? Well, that means looking at the areas of the market that are still growing and then buying those, or at least some of those investments for a diversified portfolio, even if those investments have, I guess, or are trading at higher prices. And first one I wanted to talk a bit about is Alphabet. And we'll show a chart of Alphabet here. Alphabet is part of the Magnificent Seven, as we've called on the show. And these are one of the names, one of the largest companies in the world, big cap tech. And for the most part, it's been the big cap technology names that have powered the stock market higher. And so when individual investors are looking to grow your portfolio, and we know the economy is slowing both in Canada and the US, there are only a very few areas of the market that are actually showing growth or showing signs of growth. And one of them is in the big cap tech area, powered by artificial intelligence. And that's something we've discussed on this show many, many times. And Alphabet fits the bill. But Alphabet is trading at around 24 times earnings. So you're paying a high price to buy those shares. But I think it's something you still want to look at because this is where the growth areas are. And the market and other investors who are piling into these names are forcing individual investors to pay up for these areas of growth. Another stock that I have on the list here to take a look at would be Microsoft. And as you can see, another big cap tech name. Microsoft trades at around 30 times earnings right now. And again, another name that for individual investors, you've done very well in this name over the last little while. We've seen the stock come back or pull back a little bit from its all-time highs in and around $350, $360 in that range. And it's pulled back now into the 320s. But again, paying a premium to get the growth in the portfolio or to have growth in your portfolio. And lastly, a name that I've spoken about many times on the show, a name that I actually have been putting a lot of money to work in, Amazon. Amazon is a name that I think can still grow. When you look at Amazon, after its big split that it had, the price of Amazon used to be around $170, give or take, trading today at $137. It actually, that's when we took those charts, I think it was just the other day, just yesterday, but it actually got up to about 140, 145 recently. And I think this stock can continue to move higher. Amazon actually trades at a whopping 60 times earnings. And you're thinking to yourself, there's no way I'm going to pay for 60 times earnings. Well, I think a name like Amazon, you have to look at other metrics as well, not just the price to earnings multiple. And I always encourage individual investors to look at other forms of evaluation, looking at it in different ways. You got to look at price to earnings, but you also have to look at their growth rate. And I think the PEG ratio, price to earnings to growth, is even more important than just looking at the PE ratio or the price to earnings ratio. So these three names are three names that I think you can look at. And yes, you're paying a premium, but you're paying a premium for growth. And when you're in a slowing economy where there aren't many areas of growth, I think paying up for growth at this time can make sense. The third point and last point I wanted to discuss, we're circling back to chip makers. And we've talked about the chips companies quite often on the show. Chip companies powering artificial intelligence like NVIDIA. We have a chart on NVIDIA, recent chart on NVIDIA. But not just NVIDIA. You can look at a bunch of the chip makers, and we'll keep the NVIDIA chart up for a second. But you can look at names like Micron and AMD, which I will show a chart of in a moment. But you can look at Broadcom, Qualcomm, and Western Digital, which just received some upgrades recently from a few firms in the US. These are all the chip makers that once were flying high and now have sold off a little bit. And we have NVIDIA here in front of us. And you can see on the right-hand side of this chart or of this graph that the name has sold off. We got up to about $500 a share on NVIDIA. And today it's somewhere around $430. So could you circle back to NVIDIA, a name that a lot of analysts have $800 targets on? I saw someone with a $1,000 target on NVIDIA. Now, by no means am I saying that NVIDIA is going to go up to those high rates, but everyone is bullish on NVIDIA, a name that produces chips to power the artificial intelligence. Another chart that we have here is AMD. I like AMD because this name too has dropped significantly, recently as high as 130, 135, now down to just above 100. So down about 25, 30%. Once upon a time, a few years ago, AMD was around $150, $160 a share. And we're all waiting for this artificial intelligence announcement from AMD. Will AMD come up with a chip that is actually cheaper than NVIDIA's chip and be just as good? That's what we're all waiting for. That's what the CEO, Lisa Su, has promised us. And so we all wait on what AMD is going to do and what they're going to announce. So circling back to chip makers, perhaps consider a chip maker. Now, again, not for the faint of heart. A lot of these names that I've mentioned, the two names I had charts on, AMD and NVIDIA, these are all considered medium risk, but make no mistake about it, they will be volatile. So going forward, what should you focus on? Well, you need to focus on the Fed, announcement coming up today. Perhaps look at names that have done most of the heavy lifting this year. You may have to pay a premium for some of those names, but I think it's worth taking a look at. And lastly, don't forget the chip makers. They have now come back, they have now pulled back, and can be a very good investment for those looking for growth and for those that can handle the volatility. At the start of the show, when we had Pattie on our show, and I talked to her about, what is she hearing from individual investors, the average person walking the street, small businesses, talking about where they're at, what are they telling us about their finances and about, what's going on with their household. Are they finding it difficult to make ends meet at this point in time? We still have elevated inflation. We have now higher interest rates. What is happening to people that we don't necessarily hear from on a regular basis? We tend to always see the macro data, looking at things 30,000 feet in the air. But how many of us actually get on the ground and talk to people, interview people? Well, that's where I come in, I guess. And I have the privilege of talking to a lot of people on a regular basis. And I'm really starting to see that these higher interest rates are starting to affect them. More and more, I'm hearing from individuals talking about how they keep getting notices from their banks that they need to spend more or pay more towards their mortgage. Interest rates are going higher, and the bank is saying you need to pay more just to keep up with rising interest rates. You're not even putting any money against the original principal of the loan. Same thing for lines of credit. And it's really starting to slow things down. People are talking about, well, I have money now, but I'm not going to spend it on things that I don't really need. They're going to buy the necessities, obviously food, etc. They're not going to go out and buy another laptop, or they're not going to go out and buy another TV, or maybe not going to go out shopping as much for clothes if they don't really need it. So discretionary spending is down, and we're seeing that in the stores. We're seeing inventory levels lower because businesses don't want to carry a lot of inventory in the fear that if we do go into a mild recession, that they're going to have to, get rid of that inventory, and maybe through markdowns or sales. And obviously that costs the business money. I have a chart here, and by no means do I want to scare anybody with this chart. It's a chart on Canadian bankruptcies, and you can see how bankruptcies have kind of ebbed and flowed. Here we are this year, July, a couple of months ago. You can see how the chart on bankruptcies has fared. Some years or some months higher than others. Obviously, the month of March this year, what was happening at that point? Well, we saw the highest bankruptcies, but that was also when we had a bit of a mini banking crisis in the US. Not sure if those are related. Things came back down in April, but have again surged to beginning of summer in June, and now pulled back in July. But we're starting to hear from small businesses that, they just are finding it very difficult to make ends meet. Expenses are rising, wages are rising for their employees, and unfortunately, business is not rising. In fact, it's slowing down, and they just can't meet the demand or their expenses. So overall, I guess the message I want to convey is, yes, we are starting to see a slowdown in the economy. We're starting to feel more pressure. The average person is starting to feel more pressure. Hopefully, the Bank of Canada is doing their homework. Hopefully, the Bank of Canada is talking to a number of people out there just to see how things are, and hopefully they'll take that into consideration before they make their next interest rate decision. So I want to talk about the top 3 things, in my opinion, that have helped bring down the inflation rate. And you're going to notice that higher interest rates by central banks is not on my list. So for me, the top 3 things that have brought down or helped bring down the inflation rate. Number 1, lower energy prices, lower oil prices helped bring down the inflation rate. And we have a chart on WTI crude, or price of oil, as we like to call it. Obviously, we have the Western Canadian oil here in our country, but a lot of people go by WTI crude, which is the US number, or Brent crude, which is the rest of the globe or European number. So we can see here how the price of oil for quite some time was pretty low. And really not until the month of July did things start to tick higher again. And now look what we have. We have inflation, or at least the top line number, or the headline number, moving higher once again in our country and in the US. And that's because higher oil prices. So obviously lower oil prices brought down the inflation rate. And now the worry is higher oil prices will bring the inflation rate back up again. The second point, or I guess second on my list in terms of helping to bring down the inflation rate, was the return of people to the labor force or the workforce. People are now back working once again, whether they're working part-time from home and in the office part-time, or whether they're working full-time 5 days a week in the office. People are back to work. When we came out of the pandemic, many people refused to go back to work. And in my opinion, that helped cause the inflation rate to rise, because there weren't people around to produce supply of goods so that we had more supply. The demand was strong coming out of the pandemic. People had a lot of money saved during the pandemic because they didn't travel. Government subsidies were there, but the supply wasn't there to meet the demand. And bringing people back to the workforce, people agreeing to come back to the workforce, I think has helped bring down the inflation rate significantly. And of course, inflation going up, the rising costs of goods has forced people to come back to work to pay for that rising cost of goods. So I think they both go hand in hand. And we have a chart here on Canadian employment, and you can see how the employment numbers looked fantastic at the start of the year. January, 150,000 jobs created. Unbelievable number. And now you look to the right-hand side of our chart, and you can see we actually started to see a few negative months of job creation. And that obviously is not a good thing. We want to continue to see job growth. I know the Bank of Canada wants to see job growth slow down, again, to fight inflation. But I think for me and for everyone probably watching, we want to see jobs growth. We want to see good quality jobs, higher paying jobs. And the good news is that we've seen that over the last few years, but things are definitely slowing down. And obviously, people coming back to the workforce helped, in my opinion, bring down the inflation rate. I think if people start losing their jobs because the economy is slowing, maybe that will work negative and have inflation start to tick higher if we start to see job loss. The third topic, or the third, I guess, thing on my list that, in my opinion, has helped bring down the inflation rate is this whole notion of supply chain issues easing. Coming out of the pandemic, as you can imagine, there were a lot of bottlenecks trying to bring parts over from different parts of the world to build a car, or to build some sort of electronic or whatever your business was building or creating. The supply chain was low. Supply chain of clothes. I can remember going to some of the stores and seeing the shelves empty or half full only. And that was because supply chains around the world were slowing down. I remember seeing on the news all those freights off the coast of of the United States waiting to bring their goods in, but there were just lineups and lineups of these ships waiting to dump their product onto the shore, and they just couldn't do it. Bottlenecks were really cramping up, slowing up the economy. And so now we're seeing an easing of these bottlenecks. Still, I hear from some individuals in certain industries that there still are some issues with supply chain, but for the most part, if you're looking to get some sort of product, the amount of time you need to wait has been cut down significantly. So again, to reiterate, the three things that I believe has brought down the inflation rate, and none of them are higher interest rates, are lower oil prices, labor force participation, or people coming back to the labor force, and supply chain gluts being removed. And yes, of course, higher interest rates has helped bring down the inflation, but I think that's been more on the demand side, not on the supply side. And if we see higher oil prices, if we see the labor force start to shrink, if we see supply chain issues reemerge, then there is a good chance that we could see inflation move higher again in the coming months. But hopefully that will not happen. And hopefully we can start to see oil prices return back down into that $65, $70 range once again. Money management. It's interesting. I was speaking to somebody in the last few weeks, I think it was last week, and they were talking to me about what they heard is important, what one of the, investment advisors somewhere else was saying is important that investors need to do before they can start to create a portfolio. And one of them was to create a mission statement. And I think it is important to have some sort of statement whereby you identify what you want your money to do for you. Now, for me and my clients, it's usually done through a conversation. I know a lot of advisors out there, they may put together this fancy statement, maybe a few pages in length, put some glossy cover on top, and they charge for putting this together. Well, I think that's silly. I don't think, number one, you should charge for something like that. I think overall, this should be a conversation that an investment advisor should have with all of their investors. And yes, you should have notes in your files, and so you can refer to them when you go back to your client and you want to make recommendations. Obviously, note taking is key. But I guess in knowing your client is most important, and creating documents just so they look fancy and so someone perhaps looks good is not what I'm all about, and not what investment advisors should be about. And in my opinion, two things stand out when you talk to an investment advisor, when you want to interview one to see if you should take on their services. And those two things are knowledge and experience. There are no substitute for knowledge and experience. Does the investment advisor follow the markets? Do they have their finger on the pulse of the markets? That's knowledge. And experience. What did they do when things were tough in the past? Did they run and hide? Did they have a plan of action? Did they have a strategy? That to me, or those two things to me, are two of the most important things you should ask an investment advisor. And looking at a graph that we have here can illustrate that. The first one, the S&P 500, we have a chart, and you can see here during 2002, 2003, markets really pulled back, and again pulled back in 2008 and the start of 2009. The market hit its low point in March. What did your investment advisor do at that time? I think that's a great question to ask. What is their strategy? And I think it's important to know and what is their strategy. And again, this is where the experience part comes in. We've all seen, well, many of us have seen corrections, but how many of us have lived through the dot-com bubble bursting, the financial crisis? Last year, 2022, fourth worst year for the S&P 500 on record. And why was that? Well, that was because interest rates were rising at a very rapid pace. So living through those times, I think, gives you experience that cannot be measured. These are things that have helped individual investment advisors get through times in the past, and experience will help them get through times in the future. I have a second chart here talking about tech stocks versus yield. And this is where the knowledge comes in, understanding that as yields seem to go higher, the 10-year government bond rate seems to go higher, the NASDAQ 100 slumps. So the top 100, mostly technology companies, they actually pull back when yields move higher. And this is the knowledge part, knowing that this relationship exists, knowing the relationship between interest-sensitive stocks and higher interest rates. That is knowledge, and that comes about by learning, by watching, by listening to others, and obviously comes from experience as well. So to me, I wanted to talk today or bring up the point of money management, because to me, more important than anything, more important than having some mission statement or something given to you, a plan that is written up and looks so nice, it's talking to your advisor. It's talking to your client if you're the advisor. It's understanding what the needs of your client are, understanding their risk levels, understanding their investment objectives. There's no substitute for having a conversation. And of course, at the Allan Small Financial Group, we have these conversations on a daily basis. So going forward, for any of you that are interviewing someone, perhaps to be an investment advisor down the road, knowledge and experience. There's no substitute for either of them. I believe the fourth quarter will be positive for individual investors, and I believe that this whole notion of seasonality and central banks stopping the interest rate hiking cycle will kind of coincide together. So first, interest rate hiking cycle. I think that even if we do see another rate hike in the US, I think they're one and done. I'm hopeful that the Bank of Canada will not raise again. But again, if they were to raise rates, I'm hopeful that again, it will be a one and done, let's say at the end of October. So if that is true, and if interest rate hiking cycle is coming to an end, I think this market will start to gain traction. I think it's going to gain traction in, as I just said in my previous segment, some of the interest rate sensitive sectors of the market. I think bank stocks will do better going forward, even though interest rates may start to come down a little bit. But I think this getting through the hiking cycle is extremely important for us to understand where is the end point. I think when we have some certainty, that's when markets are happy and are excited. The other thing is the seasonal factor. And I have a chart here which clearly illustrates the seasonality effect. We know that the market has its best years at the end. The market has its best months at the end of the year. And we also know that August and September tend to be not the greatest. And this chart shows it. You can see here at the start of the year, markets rise. By mid-year, they kind of flatten up. And you can see here, September, they start to pull back. And that seems to be a seasonal pattern. But if you notice, November, December, they move significantly higher once again. And the steepness of that curve is actually quite nice, a lot steeper than what it was at the start of the year. So this clearly shows that historically, markets outperform in the fourth quarter. As we always say, the period between October and May outperforms the period between May and October. You know, all that sell in May and go away stuff. Well, that's where it comes from, this seasonal effect of the market. So I think this fourth quarter will be positive. I think the stock market is waiting just to get through the month of September. If we can get through September even or roughly at the break-even mark, either slightly up or slightly down, I think that'll be a win for the markets. I think we're going to see central banks stopping the interest rate hiking cycle sometime in the fourth quarter, and that seasonal effect will kick in. And I think the fourth quarter is looking pretty good for individual investors. So now my favorite part of the show, where I can, I guess, take a look at some of the questions that have been asked during the show, that have been asked over the last couple of weeks. And unfortunately, because of our guest, the show ran a little longer today, but I wanted to get to one question at least. And this was a question that came up during the last couple of weeks that was sent to me by email, a very different question that we normally get. But here it is. I realize Berkshire Hathaway has plans for after Warren Buffett's passing at some point. But as he is approaching his 93rd birthday next week, which I guess is the time when they wrote this question, what do you believe will be the short and long-term effect on Berkshire when that day arrives? A great question. In Berkshire Hathaway, one of the largest companies in the world, Warren Buffett, probably the best investor of our generation, obviously getting on in years. And a lot of what happens at Berkshire Hathaway, yes, still goes through Warren Buffett, but a lot of it now has been passed on to other individuals that would pick up after Warren Buffett decides to retire or is no longer with us. I think initially we probably would see on the news of something negative happening to Mr. Buffett, we would probably see the stock pull back. But I think over the long term, I think going forward after that moment, I think Berkshire will be just fine. I think Warren Buffett, as well as the people there alongside of him, have set up that business to run itself. A lot of the things are almost on autopilot. There are obviously a lot of cash there that needs to be dispersed and invested. So that is what will happen in the future. But make no mistake, it's a fantastic company that is already being run by a number of individuals, not just Warren Buffett. So with that, I want to say thank you once again for joining us for the show. Thank you for taking the time out of your busy day. I know the show went a little longer than normal, but hopefully all of you took away something that you could use before you make your investment decisions. Catch our next episode on Wednesday, October 4th, again at 12 noon. And until then, happy investing.